All right, gang. So you've made it this far. You have been equipped with lots of wisdom and knowledge. It's an exciting moment. So now you have to figure out, what am I going to do with all this knowledge that I have, all these tools that I've been equipped with? Well, this is where we are with the execution section. First, we must have a trading plan. So I'll call it the Wall Street Jack Boys game plan. Okay. And the game plan is our strategy to, trading. Before we ever get into a trade, we must be familiar with the trading plan. You must have a trading plan, okay? Now, in this example here, this is my trading plan here. This is just a guide for you. Everybody's trading plan is going to be unique. The reason why it's going to be unique is because everybody is different. Everybody has different variables that are different. So there's no two traders that are the same, okay? You may be working, your colleagues may not be working. You may have a small account, they may have a big account. You just can't be copying other people and expect to get the same results. So you have to tweak your trading plan, or actually tweak this trading plan to fit, your lifestyle and your account, okay? But this is a really sound, strategy in the plan here, okay? So also make sure you download it in the material section on the website so that you can have you a nice little copy like I have here in my hand. And I keep that printed up right next to the desk so that I'm familiar and I can see it just in case, So I do encourage you to do that. It'll be in the material section. All right. So taking a look at the Wall Street Jack Boys game plan here. It's a simple 5-step process here. All we're going to do is basically choose our stocks. Okay. So we have stock picking. We have our technical assessment, which is our analysis. We choose the best strategy, which is the strategy selection. We will execute on our decision there, and then we will manage our trade. So again, simple 5 steps here: stock pick, technical assessment, strategy selection, execution, and management. All right. So let me explain to you each of these sections, how I actually use them. Okay. So when we get into our stock picking, step number 1, we just want to scan for high liquid stocks with over 200,000 volume and over $10 in stock price that has options, okay? The thing is, we're trading options, so we need liquidity. You don't want to trade illiquid stocks. You want to make sure they have some liquidity. I like to use 200,000 in volume. Some people like to use half a million in volume. Whatever you choose, as long as it's over 200,000, and that's great. The $10 stock price is make sure that you're not trading penny stocks with this strategy, okay? Because you might as well just trade the stocks if you're going to, trade under $10 stocks, right? Instead of playing with the options. So $10 is, again, it's another filter for us. And we do have, in the course, you guys have the scans that you can actually, download, upload into your platform. So basically, you just want to scan, want the scanner to do the first part of the work for us, okay? So that's in the stock picking section. Now, under the technical assessment portion of our plan, which is the next step, is our analysis. So once we find the right stock or the best stock, we want to perform an analysis. In our analysis, we're going to be looking for a couple of things, right? For one, we want to identify the trend. All right. So we have our screen setups here. Okay. We have our anchor charts and the daily charts. The anchor charts and the daily charts, those are going to be critical. Okay. This is how we're going to identify the direction. Okay. So you're going to identify that, which you've learned how to do that in the previous course, in the previous lessons. You want to identify if it's a bullish chart, it's a bearish chart, is it neutral? Okay, that's going to help us with direction. So therefore, we can develop a bias on the direction. And then the next step, we want to identify the support and the resistance. Okay, we have a couple of tools. You guys have been equipped with a couple of tools that you can identify these things, like the Fibonacci, the moving averages. There are a couple of other different tools as well that you can use. That's listed here on the plan. So the key to this exercise is to identify where the support zones are and where the resistance zones are. So we want to know where those are, okay? Then the next step, we want to wait for entry triggers to enter into the trade. So this is all about the entry. How do you enter into a trade? As a new trader, I think even myself was a little confused about, like, how am I supposed to know when I'm supposed to get into the trade? I got a setup here. How am I supposed to know when I get in? So what I like to do is I like to go in on a 5-minute chart, sometimes a 1-minute chart. This would be our execution chart, which you guys already been equipped with that setup. And what I like to see on that is something like a MACD crossover. When the lines cross over and it's going up, bingo, that is a trigger. The moving average crossovers. I have radiating fires, the squeeze, Bollingers, even a pattern setup. Once the thing pops off, that just lets us know that's a trigger, okay? So if there's no trigger, We do not enter into the trade, okay? This is to make sure that you are getting the best entry, okay? Now you can get in, without it, but you may have a false signal, or you may have a poor entry point where you could have got a better entry point if you would have waited for the signal to trigger. So we definitely want to make sure we have a trigger. So for me, I don't like to jump into anything until I have a trigger. If there's no trigger, then there's no trade. All right. So the next section here will be the strategy selection. So before we can actually even trigger and jump into a trade, we need to make sure we know what strategy we're going to use. Okay. How we're going to determine the strategy that we're going to use is going to be based off of the volatility, which you guys have also been equipped with that, understanding volatility. We want to verify the volatility. If it's high, then we want to enter into a sell strategy. If it's low, then we want to enter into a buy strategy, okay? That's going to let us know the strategy that you want to execute on that particular stock. Now, there's a caveat that I have in here that says selling credit spreads is always an option, even if volatility is low. Let me explain this one here to you, okay? So keep in mind that selling spreads is always an option, okay? I know that we give you some frameworks so you can understand volatility, but you will find that when you're actually trading, okay, especially if you have a small account, and there's names, there's setups that you identify or that we call out on the website, maybe it's Apple, maybe it's Amazon, those calls or those puts are expensive. You may not have the account size to be able to participate in that trade. Does that mean that you cannot participate? No, you have options. That's why it's called options. There's other strategies that you can use. Selling the spreads will be a great option, okay? So the selling the spread strategy, in fact, is what I recommend. This is what I normally trade. No matter what, always keep the spreads on deck. This is the reason why. Timing is difficult. Direction is difficult. I know we have all the tools, but we could be wrong, okay? So if you're wrong, and say if you choose a long call or a long put strategy, you're going to feel a lot of pain. You're going to lose a lot of money really quick, okay? Those setups really don't work out as often as people think they do, okay? Because timing or direction is difficult, okay? When you're selling the spreads, it's going to alleviate that whole situation because then the time is working on your side, okay? Maybe you have bad time and it doesn't matter. You're going to make money just because time is expiring, okay? Also, the direction doesn't kill you as bad. As long as it doesn't make a rip against your position, you can still hold on to that position for a couple of days, and it's going to help you out because of the theta. So you still can win. Even if you're wrong on direction, you can still make money just based off of the volatility and based off of the time, all the Greeks, right? So selling the spreads, always on deck, okay? Credit spreads, if you're bullish, okay? If you don't have enough capital to participate in a Delta 70 calls on a particular stock name, okay? No problem. It's not the end all, okay? Go switch over to the put side of the options chain and then price out a credit spread, a bull put spread, because you're still playing a direction, okay? If it's going to go up, you're still going to make money. Now, the volatility may work against you, okay? But you're still going to you can still make money, basically, all right? You're still going to make money if it goes up. You're not going to make as much money as the long call or the long put, playing the pure direction, but you'll still make money even if you trade the spread. So always keep that on deck, okay? And I want to say that because as a new trader, you're going to see lots of setups and some of the name brands, and you're not going to be able to participate because you don't have enough capital to risk. You may have enough in your account, but according to your risk management parameters, you may not have that. You may not be able to stomach that kind of risk, okay? So always keep the spreads on deck. Now, after we actually get to that portion, we want to go into our execution, okay? And so once we get into our execution, this is all about just finding the right strikes, okay, to execute our strategy, right? So we want to sift through the expiration series for the best premium and open interest, right? If you're doing like a long strategy, like a long call or long put, the shorter expiration series are going to be cheaper than going out further in time where you're going to pay for time. But when you're selling, if you're doing a sales strategy with the spreads, the more further you go out in time, the more credit that you can receive, the higher the premium you can receive. So we just want to make sure that we're sifting for the right expiration series. And ideally, I like for, trading the options around 30 to 50 days. Okay. You really don't want to go outside of that. You really don't want to go over and beyond that because, theta really isn't going to be working for you once it gets beyond this period. We want for that theta to start working for us once you get under like the 30-day threshold. it really starts to eat up really fast, and that's going to help us to make money, more money faster. So those are ideal. And then it also gives you time to be right. And, just in case, a couple of days, the markets is choppy, you got time, right? So you don't have to panic if it's going against you. You still have time to sit in the trade. Okay. Now, the next step is that we want to make sure that we're choosing strikes that have at least 100 open interest. Okay. This is for the liquidity purposes. If you're choosing strikes under 100 open interest, then you may get stuck in a trade. We don't want you to get stuck in a trade. That's not a good feeling. So choosing the 100 open interest is, a good place to start so that you don't get stuck in any trades, okay? Also, we want to choose the probability out of the money, ideally around 60 to 90% for credit spreads. So again, credit spreads is going to be the bread and butter. And all you have to do is go look for the OTM, the out of the money, for around 60% to 90%. You really don't even want to go over 90%, but 60 to 90% is where you want to be choosing your strikes at. And so just always go to the 60%. Bingo. Start at 60% around there and then look for something higher, because we want the math to be on our side. We want the probabilities to be on our side. This is why it's called high probability trading, okay? This setup is a high probability setup. For one, we've done our homework, our assessment. That's going to help us out. And then also the math is going to help us out, the probabilities. So if you got over 50%, then that's not a coin toss. 50-50 is a coin toss. We want to have something over 50%, right? Therefore, the odds are in our favor. So that's why we're choosing those strikes. And this should expire out of the money, meaning that we should make money by expiration. And then, again, if you want to choose the long strategies, go for the Delta 70s, all right? Identify your risk reward and make sure that the max loss fits your risk management profile for your account size. And we haven't done too much talking on risk management. We will get into that in the next lesson here. Once we crack open the Wall Street Jack Boys Trading Journal, I can show you better. But we just want to make sure that you're not, risking too much on your account size. This is one of the number one reasons why a lot of traders blow up their accounts and they can't make it back because they don't wasted all their money, lost all their money because they put too much risk on. All right, so there's a method to that madness, and we'll go over that. And then also we want to I put in here about adjusting. Okay, so you may need to adjust to take in some more premium. There's a selection, there's a suggestion here that says just add more contracts or widen the spread. You may also select at the money strikes to collect more premium. This is going to be interesting because when you're actually live trading, looking for setups, when you get to the options chain or whatever name that you're looking at, because again, the charts is one side of the equation. You got to get to the options chain after that. So the charts, we have a setup. We get to the options chain, and when you get there, premium may be skimpy, okay, meaning that it might not be attractive enough premium for you to collect. So then you will go into adjusting the strikes to try to get more premium. There's different ways you can do so. You can widen the spread, okay? So say if it's a $2 wide spread, okay, a 2-point wide spread, you may want to widen it to a 3-point spread or a 4-point spread or a 5-point spread. You can go all the way to 10-point spreads, okay? The wider the spread, the more premium you'll be able to collect. However, you're adding up more margin, okay? It's 5 points, that's $500 margin, right? So you take a look at it that way, okay? If you go to the option chain and you're trying to execute that spread, you're not seeing enough premium, try to adjust the strikes. You can get more premium. Make sure that you can stomach the risk, okay? That's just one suggestion. Also, you can add more contracts, okay? So say if you like the setup that you have, it's not enough premium, well, just double the contracts up, right? Instead of doing one contract, do 2, do 3, do 4, do 5, and see if the risk management still, see if the risk still matches your profile. Make sure that you're not over risking. Make sure risking only enough, for your parameters. Which again, we'll go over that, in the next lesson. Also, I put in here that you can go to at the money strikes. Just understand that when you go to at the money, you'll be able to take in more premium, but the math is no longer on your side. Now you're going into, gambling, okay, with the probabilities. You can still win, you can still make money, but the math is not on your side. The odds are not in your favor once you go to that 50%. It's a coin toss, okay? But you can go under 60%. Can you go to 55%? Yeah, you can. I mean, it's still closer to that coin toss zone. So these are things that you can't be rigid in your approach, because when you get into the real world, you're going to be challenged with those things. And I just want to address that here, and it's in the trading plan. It's how you can do workarounds on that, okay? And then after you finish all of that, then you will execute your order, and then you will keep track of the trade price and the mark price in the Wall Street Jack Boys Trading Journal, okay? So again, we offer the Wall Street Jack Boys Trading Journal here. Make sure you get your hands on it. If not, you can also do it yourself manually, just tracking your trades. But you will see, once you see the Trading Journal, it's a no-brainer to get it. All right, so after the execution portion, then we go into our management phase. Under the management phase, we want to manage our winners and manage our losses, right? So the whole key here is to maximize our wins and to, minimize our losses, okay? We want to cut our losses short and let our winners run as much as possible. But the environment changes. So not all the time will it work the same. You have moments in the markets where they're more volatile than other times. So then we have to adjust our strategy, okay? So one thing that I like to do is to exit my winners once they hit a 50% profit target, okay? Your P&L is going to tell you that you're at 20%, 30%, or negative 20, or negative 30. Once it hits positive 50, okay, positive 50%, that lets me know that I need to be taking off right now. I need to be getting out because I made my money. No need to be greedy, okay? Because that greed will turn around and bite you in the butt, and you will see once you start trading how, man, I wish I would have took that 50% when I had it. Now I'm negative 20. You don't want that to happen. Once you hit your target, you exit, okay? Also, another target zone I like to use is my Fibonacci extensions. Some people will be more skilled at Fibonacci's than others. I don't expect you to be, professionals. It does take time to get it, but just understand when you see the 1272 targets and the 161 targets, those are profit taking zones. So if my setup hits those zones, I'm out. So that's another way that I manage my wins. And what I also do to adjust when volatility hits the market, say like election season or something, crazy is happening, I adjust my profit target zones to like 30%, which is a lower profit taking zone, which is going to be critical for swing trading, because when you swing trade in the high volatile zone, it's really difficult because the days are really choppy, huge ups, huge downs. So you want to execute with some kind of, profits instead of, losing it. Because if you're trying to aim for 50%, you may not get the 50% in a volatile environment. And then you risk losing everything that you have accumulated by failing to, go ahead and close that trade out at a 30% target, right? So how do we know when the environment is more volatile than others, right? We talk about the VIX often, and I cover this in the Game Plan Sunday sessions. Where we take a look at the VIX. The VIX is a good indicator for when the environment is volatile. When you see the VIX rising, that means things are getting treacherous. So be careful, adjust your profit target zones. If you're at 30, 40%, go ahead and take the profit so you can realize that. Now, losers, you want to exit losers. I got 50% here. So if you hit negative 50, you want to be exiting those losers if you hit negative 50, because you don't want to have huge losses. You want to minimize those losses. And it's okay that you're losing, trades you're down 10%, 20%, 30%, because, again, they're moving up and down. And if you got time on your side, then you can withstand some of that pain. When you hit about 50% target, then you really want to be looking at to exiting, okay? Make sure you don't lose, you don't want to lose 100% basically. But when we calculate our risk, we're calculating at 100%. But we don't really ever want to lose 100% or greater than 100%, because you can lose over 100%. So again, we want to cut those losses around 50%. Or if the Fibonacci extensions, which is showing on support, if the price breaches those zones, then that's another trigger that I use to exit with losses. So with this trading plan, you guys have learned how to execute the trades. You also learn how to manage your winners and manage your losses, so you understand how to mitigate your losses. So again, just a quick recap here. We're going to pick our stocks. We're going to do technical assessment, technical analysis on those stocks. We're going to choose the best strategies for those stocks. We're going to execute our trades, and then we're going to manage our winners and our losers. There you have it.